Hello and welcome to Connect and Collaborate. I'm Alex Hopkins, your on-air producer, and I am very excited this week. We are talking real estate, and it's a pretty hot topic here in Colorado. And one of the things that I get to do this week is actually I'm talking with a mortgage lender. I have with me Megan Gerhart. How are you?
I'm doing good. Thanks for having me, Alex.
Yes, of course. So, real quick for our audience, I just need to reiterate to make sure you sign up for our newsletter at cobrt.com. Check out our events page while you're there and listen to this show and more at cobrt.com/radio podcast. So, Megan, how's your day going so far?
It's doing really well. I got up super early and came in early, and I've been chatting with you for about 45 minutes, so
Yeah,
can't complain.
exactly. Well, thank you so much for joining us. So let's start with a little bit of your background and how you ended up at being a mortgage lender.
Sure. Well, I kind of fell into it. Well, I lucked into it, I guess. I was working in customer service, doing other things. I got injured and, couldn't do the sort of bending and twisting that I needed to do with my previous career. So I needed to switch. I had a friend who was in the business, and she got me set up as a receptionist, kind of working minimum wage and starting from the bottom. And yeah, I got bored.
Weird.
Yeah, I get bored real easy, so I was just kind of like, hey, everybody in the office, toss me what you can. And that kind of um, got me into it, kind of got a toe into processing and closing and, just all the little facets of the loan program or the loan process.
Yeah.
Yeah, so it was kind of fun. I really enjoyed it, and I guess I was good at it, so I got promoted pretty quickly.
Nice. Yeah. See, if you just ask, right? I think curiosity is really underestimated in the workplace, right?
Absolutely, yeah. I mean, I think if you're sitting there waiting for something to happen, it's not going to happen. You really have to kind of go for it.
Yeah. Push a little bit, right?
Definitely.
Tell me what you need me to do. I want to learn things, right?
Yeah.
I've been there before myself. Um, So you work for Cherry Creek Mortgage Company,
I do.
and I have to tell you that I've had a few real estate agents that I've talked to over the course of the week, and you guys have a pretty awesome reputation.
Well, thank you. We definitely work hard for that. Cherry Creek is an amazing company to work for.
Yeah. So tell me a little bit about the background of Cherry Creek.
Well, so they're Colorado proud.
Yeah.
Cherry Creek was started by a guy named Jeff May, who was already in the finance world. And he just kind of, I mean, he took a look around and he saw a lot of stuff that didn't really, it wasn't really in keeping with his personal moral tenets. He saw irresponsible lending. He saw people just taking shortcuts and not focusing on what's important or what's needed for the client, but just trying to get the loan closed by any means necessary. And I just don't think that his conscience would allow for him to lend that way. So,
Yeah.
and I know Jeff a little bit. He's a giant teddy bear. He's just the sweetest guy you've ever met. So I believe it. So yeah, I mean that was about a little over 30 years ago. And so he started Cherry Creek, where he could make his own way and generate a business that's based on his own personal morals and what he thinks is the right thing to do.
That's awesome.
Yeah.
So clearly they were around for the 2008
Yep.
bursting, right? The bubble that popped on
Yes.
real estate. Do you have any facts on that about how they were? Because I know you weren't there.
I wasn't
right?
there,
Yes,
right? I was
obviously.
a teenager then. I do know a little bit about that actually. I was really curious when I got started with Cherry Creek because I knew that they survived it, and
Yeah.
not a lot of mortgage companies did. So I asked, and I mean, it makes a lot of sense when you know them and when you start doing business with members of the team. It makes sense why they survived. But essentially, I think the reason why the economy kind of crashed. It had to do with people lending and creating these loans that weren't sustainable.
Right.
A lot of that has to do with getting somebody qualified for a loan without checking their income, without, yeah.
I didn't even know you could do that.
Well, you can't do it anymore.
Well,
I mean, you
obviously.
kind of. I mean, they had to really relax their guidelines, and this really started, at the beginning of the '90s. There was some legislation that was passed where we were really trying to push people into home ownership, and not everybody qualifies for that.
Right.
So they were just like, well, we'll just figure out a way. So we stopped verifying income. We stopped requiring people to put money down on a house. Yeah, it was a time that thankfully I wasn't a part of, so I don't have to carry that burden myself. But I think that Cherry Creek survived it because they didn't do stuff like that.
Yeah.
They made a choice not to lend that way when they got started, and I think that that's something that they've held on to throughout their time here. So I think that that really is what kept them alive.
Well, and that's probably why they have such a great reputation amongst realtors,
Hmm.
right?
Yeah,
Yeah.
responsible lending. That's really
Yes.
what they go for.
Absolutely. And well, and I love that they've got integrity, right? That's congratulations to Jeff for keeping that up. It's sometimes hard to keep your morals up in the business world, particularly in finance,
Yeah,
right?
yeah. Money is definitely a big corruptor. So I think it says a lot about his character, and really beyond just him, but the people that he chooses to, come onto the company, who then hire people beneath them. I think it starts from the top, but he's really found a way to trickle down his own personal moral code.
Yeah.
So everybody kind of operates that way at Cherry Creek.
Oh, that's awesome.
Yeah.
It's good to hear that you've got some morale in the office and everyone participates, and it sounds like it's a good environment to be in.
Oh yeah, it's great.
Yeah.
It's the best.
So I want you to walk me through a first time buyer process. So I am one of those people that cannot afford a home right now here in the Denver area. It's just out of my grasp, right? Can't
Sure.
afford a $400,000 home,
Right.
which is the median, right? Or 450, I believe, is what we're at now.
Yeah, it depends on the city.
Obviously, yeah.
Denver is definitely getting up there quickly.
Yeah.
But yeah, it's not sustainable.
It's pretty tough, and I don't want to end up because I'm sure that I might be able to qualify for something, but I don't want to be house poor either,
Exactly.
right? I want to be able to enjoy the house and still go out.
Absolutely.
Yeah. So, do you mind walking me through what it's like for what assets do I need to give you, right, to be able to qualify, and walk me through that if you
Yeah.
don't mind.
Oh yeah, totally. So I would say if you were like, hey, I don't feel like I qualify for anything, and I know I'm not ready, I would still suggest talking to somebody,
Okay.
because if you kind of get a good grasp on your financial picture, what where you need to be to qualify easily and still feel like you can live a life, you should do that well before you're ready to buy a house.
Okay.
The average folks, I think 2 months or something before you're ready to buy is fine. Talk to a loan originator, give somebody a call, and just start talking about your comfort zone, what kind of monthly payment you're, comfortable with.
$50.
I can't help you.
Oh, all right.
But yeah, I mean, so I would just say start early, talk to somebody quickly, and well before you're shopping for a house. Once you're talking to an originator, you're going to start talking about what kind of property type you're looking for: a condo, a house, a townhome, maybe a manufactured house like a mobile home. So you're going to talk to them about that, and each one of those properties has something different with their loan.
Okay.
So it's definitely an important factor. You're going to talk about your purchase price range. So what kind of house are you looking to buy? How much house are you looking to buy? Again, you're going to talk about your monthly mortgage comfort level, things like that. From there, you're going to fill out a loan app. So you're going to go, to, like, my website is Mortgages by Meg. Click Get Started, and just sort of fill it out. It's super, super user friendly, and it flows really easily. So you kind of just follow the questions, answer honestly. It's definitely financially invasive, so
Yeah.
be prepared for that. We're going to ask you a lot of questions about what you do for a living, how much you make. All of that stuff is kind of on the table when it comes to a loan like this. This is a significant financial investment for the average the average person. So,
Oh yeah, it's a big investment, right?
yeah.
It's well, and I don't know about you, but it's been my experience that talking about finance is more taboo than talking about sex this day and age in America.
Oh my gosh, yes.
Yeah, right?
Absolutely. I mean, I don't know about you, but my
Mhm.
dad always told me you never ask somebody how much they make.
Yeah,
It's like a naughty word.
it is. It is. It's almost rude. It's
Yes.
considered very rude. Whereas I, on the other hand, I'm happy to tell my friends what I make and my degree, and I'm happy with where I am. I should share that. And
Yeah. Well, you're an
um,
open book, Alex.
it's true. I am. um, well, I want to ask you. So, are you suggesting that I talk to a mortgage lender before I talk to a real estate agent?
Not necessarily. I
Okay.
think you can do those two things in tandem with each other.
Okay.
And I definitely think you should, whoever you talk to first, just do this well before you're ready to start doing it. So you can totally talk to a realtor well ahead of time and just get a feel for the market. Start talking to them about what kind of houses are available for you, what kind of, how many properties are available in my price range, and things like that. It's totally a great idea to do that. And you can do that at 8 a.m. and at 4 p.m. call me.
Okay.
You can do it in the same day if you want to. They are financing and a realtor work very closely together,
Yeah.
and they're both super important to the ultimate goal.
Okay. And so you work with a slew of realtors, right? You
Yeah.
don't have, but Cherry Creek isn't only working with one.
No, definitely. I mean, an originator with Cherry Creek is very independent, so we all do
Okay.
things a little bit differently, and we all have our own referral partners.
Okay.
So typically we try to respect that. So you won't see very often that one originator is working with, Sally Realtor and I'm working with Sally Realtor too.
Okay.
So we definitely try to be respectful of our teammates and things like that. But yeah, we work with lots of different people. I mean, when you figure a realtor, might do 4 to 6 houses a year. We do that in a month. So,
Okay.
so we don't want to put that much pressure on our referral partners to like bring us business.
Yeah.
So we definitely do work with lots of people.
Nice. I wanna ask you, and I'm not sure how much you know about the tiny homes. It's kind of a
Yeah.
trend right now.
Uh-huh.
So I would imagine. So you mentioned that for each particular house, you have a different set of rules, maybe that you go by, or they have a different type of loan.
Yeah, guidelines
Guidelines.
basically.
Thank you. Words.
It's a lot to know. Don't worry. Yeah, and tiny homes are very new, and they also they have a lot of really specific features to them that are different than most houses. Like they're usually energy efficient or only running on solar panels. They tend to have their own water source. So there's a lot of things like that. And then also because it's so small, there's some like ordinance stuff to navigate.
Okay.
And I haven't done a lot of research on them recently. The last time I dug into tiny homes was probably 3 or 4 years back, and my understanding of it was it's pretty hard to lend on them.
Okay.
The key is the land you're putting it on.
Okay.
So you'll have to, and this is definitely a great conversation to have with a professional when you're, if you're specifically going for something like this. You'll want to kind of dig into maybe like buying your own your own land or something like that. So yeah, that's a good question.
Thank you. I appreciate that because it's one that's been on my radar and it keeps coming up.
Yeah.
So let's talk about. We talked about first time buyer. Let's talk a little bit about multiple property ownership,
Yeah.
right? Is there a different process or is it like buying a new home every single time you bought one?
Right. It's very similar. The process of it is very similar in terms of, how the process works. You start with processing, they verify all your stuff. You go to underwriting, they make sure that everything is compliant and, the way I calculated your income matches what the underwriter says and things like that. You go to closing, you close on your loan. That's all very similar, but the requirements for a new purchase, particularly if you're on your third or fourth, fifth, sixth, or seventh home, requirements go up. So some things that I would suggest if there's a home buyer out there that's starting to sort of build a portfolio. As a homeowner, I would say consider that a bank is going to look at you like a sophisticated buyer. So that's going to mean you're going to be putting more money down than you would if it was just your primary residence, your first home. You're going to probably have higher interest rates, not out of control high. I mean, it's, you'll probably see like a percentage or a percentage and a half difference.
Oh, that's not nearly as much as I thought.
Yes,
Okay.
not too bad, but it's definitely going to be more.
Mhm.
So prepare for that. You're also going to have reserve requirements. So consider whatever money you're putting down. Let's say you have that in a bank account and that's what you're going to bring as a check to the closing table. Let's say it's, $30,000. You're also going to be required to show a couple of months, depending on the circumstances of your loan, a couple months of reserves. So and that has to be outside of the $30,000 you're bringing to closing.
Okay.
So if you have two more properties and each one is $1,000 a month, you're going to expect to pay, to have like 4,000, even more depending on how many properties you have in some other account that we're not withdrawing, but you need to show you've got it.
Okay, so it's not far off from Monopoly then. That's what I keep going back to here.
That game remains popular for a reason.
Yes, absolutely. So tell me what I can do to be a good qualifier for this for these loans, right? For first time buyership, I would like to go in and at least have some knowledge of what I need to bring.
Yeah.
Yeah.
I actually have that written down for you.
Thank you.
There's definitely some things that everybody's going to be asked for. 2 months of bank statements, so your most recent 2 months. 30 days of pay stubs. 2 years of tax returns. 2 years of W-2s. Things like that are almost across the board going to be asked for. Prepare to give those up. Don't fight it. You're going to need to.
Okay.
And then depending on your circumstances, depending on the individual picture of you as a potential home buyer, there might be other stuff that they ask you for. So again, that's why I say if you're interested in home buying, go talk to somebody now. Don't wait until you've found a property that you really like.
Right.
Because there's prep work that's really going to help make the process easier for you. So depending on your circumstances, you might also be asked for a divorce decree, 401ks, stocks, bonds. You might be asked for a quarter of those statements, something like that.
Wow.
So, and again, it just depends. Mortgage statements if you've already got properties, and insurance and HOAs and stuff like that. So just be prepared for some very invasive financial looky-loos.
Well, I would imagine. So, and I don't know that you can answer this, but from 2008 until the market had to change, right? After that happened. So, is this something that came about after that?
No, I mean, the mortgage industry had, prior to things getting so relaxed that it caused a problem, we had always, looked into this. I mean, you're asking for a significant loan to the tune of a couple $100,000. We need to make sure you have an ability to repay that loan. And so we are scrutinizing your whole financial picture, not just looking at your credit score, not just looking at how much you make every month, but how many liabilities do you have? How many credit cards are you on the hook for? Do you have a car? All of these things are part of your overall picture. We definitely should be, I feel everybody should be scrutinizing these things because it matters. If, the reason why things crashed before were because people couldn't afford these loans, once their interest rates started rising and stuff, they weren't able to pay for it anymore because nobody checked into it. So we really want to make sure that people are able to pay back the loans that they're asking for. And if it doesn't make sense for a person's financial picture, then we're going to be honest with you about that.
Good, I would hope so.
Yeah. And that doesn't necessarily mean that we're just going to show you the door or anything, but it's important to talk to people about, what we see on their credit or how they might be able to consolidate things or, clean stuff up so that they don't have as many financial obligations each month. Things like that are kind of ways that Cherry Creek goes above and beyond to help a person really take hold of their financial picture and make sure that if they're going to buy a home, they're doing it responsibly.
So this is a lot to wrap my head around, and I love
Yes,
it. I appreciate all the advice. No, this is great. It's kind of like I'm meeting with you before I'm right. So let's talk about interest rate because that's the big deal.
Yeah.
That's what's going to make or break, right?
Right.
Being able to pay back that loan.
It can be.
Okay.
Yeah.
Yeah. Maybe I'm wrong. Please, please.
So, I mean, interest rates are going up right now.
Yes.
They had been super, super low once everything kind of crashed as we were trying to rebuild the economy. We were giving people a big break. So that's now that our economy is doing better, things are going up. They're still real low, though. I mean, somewhere between the mid fours and the high fives is.
Yeah.
For the most part, really good. And people with credit scores as low as like 620 can still qualify for interest rates in that range. So it's not necessarily the interest rate. And we're talking about fixed rates as well,
Right.
which is the bulk of the loans that we do, which means that through the whole course of the 30 years that you have this mortgage, your interest rate's never going to change.
Which is amazing.
Yeah, and that was another part of what went wrong before. There was a lot of they're called ARM loans, so adjustable rate mortgages, where you have a fixed rate for like 5 years or 7 years, and then it changes, and it just kind of depends on what the market's doing at the time that it changes. We still do those loans, but again, we only do them if the picture is right for them.
Right.
We definitely will not offer that loan if it doesn't make sense for the home buyer. So yeah, I wouldn't say that interest rates necessarily are the make or break for most people. Really, the make or break for them is how much money they're able to put down. Mortgage insurance is a big factor. I definitely feel like people don't know or ask a lot about mortgage insurance, and it's huge. Is it cool if we talk about that?
Absolutely. Please
Cool.
share your knowledge.
I'm going to share my knowledge. So, mortgage insurance is something that we require on a loan if you've put less than 20% down, or if you're in an FHA loan. So, an FHA loan is a government loan, which means you get a lot of extras, a lot of kind of help for like a government subsidized loan. But mortgage insurance is always required on an FHA throughout the whole life of the loan. If it's not FHA, you're only subject to mortgage insurance if you didn't put 20% down. Excuse me. And you don't have to put 20% down. Most loan programs have a minimum requirement of like 3%, 3.5% down. But you do have mortgage insurance.
Right.
So consider that. And also consider that that really does matter. Your credit score really does matter with mortgage insurance. So it's definitely something to talk to your lender about. And it can get really pricey. I mean, it can add, I would say between $50 and a couple $100 onto your monthly payment.
Yeah.
And that really can make or break your deal. So again, something to really talk to somebody about way ahead of time to find out where you land in the financial picture and what kind of loan you might expect to have.
That's amazing. I have learned so much. So I just one more question here for you. Where can I find you? How can I get in contact with you?
I'm around. You can, like I said, go to my website. I'm mortgagesbymeg.com. I work in Cherry Creek, so I'm at 44 Cook Street. That's Suite 500. And my phone number is 303-931-0141. I'm available day and night. If anybody out there, if you have any questions or if you just want to pick my brain about stuff, please give me a call. I'm happy to chat with you about that.
Yes, thank you so much, Meg. It's been great having you on. I have learned a lot this week, and I will most likely be contacting you for more information.
My pleasure. Happy to.
Yes, so be sure to check out this podcast and more at cobrt.com/radio-podcast. And you will be able to click on Meg's information in the blog post about this show. And be sure to like and subscribe our YouTube page. Thank you so much. We'll be right back.